Our top story tonight, the Cyprus bailout gets the go-ahead. But the market response is anything but joyous. Everybody thought uncertainty removed, markets off for the running, but not the case. Despite expectations for a rally, the bulls took it on the chin today. Expectations are climbing that the painful bailout terms could come to more European countries. Will this mark the beginning of the end for the bull market, or is this just a blip on the radar? Let's begin first with Peter Schiff. Peter Schiff is the CEO of Euro Pacific Capital, and Spencer Patton is the Chief Investment Officer at Steel Vine Investments. Thanks for joining us tonight, guys.
Sure, thanks for having us on.
All right, Spencer, let's start with you first. Should we be scared about the terms of this bailout agreement? It appears that the market is.
They really should be. I mean, this sets up an awful psychological precedent. I mean, if you just imagine if this happened in the States, if some little small bank, because that's what everybody's saying, it's small, don't worry about it. If some small bank went under and the FDIC just said, you know what, let them burn, who cares, and they don't bail them out, that would set an unbelievable panic off here in the States, and that's exactly what's going on in the EU. Cyprus is small and doesn't affect anything on its own, but it could spread very quickly to Spain or Italy. You'd have to be crazy to leave your money in Spain or Italy right now.
Peter, I know you, and I know that you're not a fan of bailouts, but what about this one?
Well, I don't like bailouts in general, you're correct, but as long as you're going to make the mistake of bailing out a bank, I think the way they did this is better than a bailout where all depositors are made whole. I mean, that's part of the problem, the moral hazard around deposit insurance and the perception that even the uninsured deposits are going to be protected. I think depositors need to be aware of the risks. Remember, these Cypriot banks were paying very high interest rates on their deposits, much higher than the rates that prevailed, let's say, in Germany. And so they knowingly took more risk to get more reward. There needs to be some losses if the banks fail.
So do you think, Peter, that we will see a run on the banks after all of this?
Well, I don't think you're going to see a run, but I think some people might walk to the bank and grab their money. I mean, if you have money on deposit, certainly in any of these countries where there are problems, why leave your money in the bank, especially in today's environment where interest rates in general are so low? Why take a chance? And, you know, it's not just on that side of the Atlantic. You know, we've got 0% interest rates here in America. Why leave your money on deposit in a bank to get 0% when there's inflation? And, you know, those were the two largest banks in Cyprus that failed. Our two largest banks, Bank of America and Citibank, they have over $2 trillion in total deposits. Yeah. The FDIC has a mere $25 billion in treasuries. So if our largest banks were to fail, we don't have anywhere near the reserves to come close to covering the insured deposits, let alone all the deposits.
Yeah, let's get Jordan Coley in here. He's an analyst with Lowry Global. He's in our power panel tonight. Jordan, I guess the fear is that this is going to be used, this bailout is going to be used as a template for future bailouts, and that investors are going to say, well, my money's not safe, I'm going to take it, I'm going to go somewhere else. Do you believe that to be the case?
No, not currently, just because when I look at the global markets, if you review the major European nations such as Germany or France, you don't see the kind of deterioration that suggests that there's actually a broad-scale sell-off. And then secondarily, I reviewed the Italian and Spanish markets, and it looks like there's actually some consistency there where there's some strength. So usually what you'd want to see is if there's actual fear in the market, you'd see some selling that would make it a remarkable situation to worry about there being people coming in to sell. But right now, we don't see the kind of deterioration that suggests that there's a broad market sell-off coming.
But, Spencer, we did see a sell-off today. The market turned on a dime on this news. At first, you know, everybody thought that the markets would cheer it. Not exactly the case today. So do you think this is a short-term sell-off, or do you think this will stick around?
Absolutely, yes. On a short-term basis, the market's been overextended, so no question that there's some possible short-term correction, but from a longer-term standpoint, we don't see any reason to believe that there's actual deterioration that's going to make this a broad-scale bull market end or.
Spencer, your take.
And yeah, I definitely think that
I would hardly, I would hardly call 62 points. The Dow was down 62 points. I mean, I wouldn't even qualify that as a sell-off. If anything, the market ignored the potential consequences of what's going on and is downplaying the risks. I think Cyprus is small, but the problem is enormous and extends well beyond Cyprus. And, you know, the markets are very complacent in the face of those risks.
But Peter, we saw the market specifically turn when Dutch finance minister said that this agreement will be the template for future Eurozone bailouts. bailouts. It had been higher. It turned around in that news. And I go to Spencer. Spencer, the markets did react to this. Spencer.
They really did. I mean, you saw the euro sell off 1% today. You saw the European stock markets down more than 2%. I mean, you just give this a couple days, you're really going to see an impact here. So I think now is the time to act. You really will see this spread to Italy and Spain, because you just have to ask the question, why? If you're a depositor in Spain or Italy, why keep your money there? Even if you just move it over to Germany or some other EU country, just move it away, because the second that you have a problem in Italy and Spain, what's everybody going to be asking? They're going to be saying, my deposits are about to get snatched by the government. And, that's a real problem. You're going to see it spread.
But Spencer, just follow up on that. You can't just run and hide. If you're an investor, you've got to be in the market somehow. How do you hedge your risk in this environment?
Yeah, get in some real assets. Start looking at commodities. Oil did really well today. You saw the grains do really well. Those were all up in a down market. You saw gold basically be flat. Get in real commodities and get out of stocks, because stocks are at all-time highs. So there's no reason why you should go in and buy right now.
And Peter, we know you as a big bear when it comes to the U.S. dollar. It was the euro that took it the hardest today.
Yeah, the euro was down, but back to the stock market. The stock market doesn't go up every day. Just because it went down today, it's not a big sell-off in reaction to the news. I mean, you're going to get some down days. I think the market should have gone down more than it did because of these problems, but I think all the money printing is what's going to keep nominal stock prices rising. But what savers have to know is, one way or another, they're going to lose the value of their deposits, because even if your bank doesn't fail, or if it fails and it's bailed out, the money that you get back is not going to be worth the money that you deposited. That's why people have to look for alternatives. Yeah. That's why they should be buying real assets, things that the federal government can't print. We're selling a lot of these gold bars that are made in Switzerland now. They're 50-gram bars. You can break them into 51-gram pieces. People are buying them to carry around in their wallets so they can use them in the case that you do have a currency
Jordan,
collapse. I think people are waking up to what's going on.
That is a very real fear. And Jordan, I'll ask you this question. Should we be fearful that this could happen here at home in the United States, that money could be taken straight out of our bank accounts? Is that a realistic concern?
I don't think so at all. There's no signs here that we're seeing that there's anything to that degree that would make us worried in the United States. Everything from our analysis shows that the United States market's very strong. We don't see any substantial fear to be worried about. And quite frankly, the contagion risk seems fairly low.
So we should stay
point.
in the stock market? Anybody who's in the stock market right now that's been riding this rally, Jordan, you're saying stay with it?
Right. At this point, we're near new highs, and the only thing that we have to worry about is a temporary pullback. But we don't see anything that suggests that we'd have some substantial sell-off, some contagion risk.
Okay.
We don't see anything that would make us worried.
We've got to leave it there, but Peter, real quick, your last word. We've got to leave it there.
Yeah. Money is already being taken out of our bank accounts. What do you call 0% interest rate?
That's a good
the interest that we used to earn. We're not getting it anymore. And what about inflation? That's eroding away the purchasing power of our savings. So we're already having money taken out of our bank accounts, and unfortunately, we're going to have more value taken out in the years ahead.
All right, Spencer, Peter, Jordan, thank you very much. Interesting argument, and also the fact that our paychecks are all smaller. They're taking more out of our payroll check just to pay for what we've done in this country. Thank you very much, gentlemen.